Apple's results are out and shares are down about 2.5% to $97.50 a share. In this video, we're going to see if that price move makes sense by plugging in management's new guidance into our earnings model. If you'd like to download this model and follow along, please visit our website, gutenbergresearch.com. If you click on the Free Models tab and scroll down to Apple, you can just click the button to download. And for the guidance, we got that from the SEC filing, the 8K filing that Apple made today. So you can see that right here in this section. And management also gave us some really good supplemental details that you'll want to take a look at. They give the breakdown of the currency impact, the strength of the US dollar. And they started reporting a breakout of service revenue. This is the first quarter that they gave this level of detail. And this is definitely something that we're going to incorporate into our earnings model. So if you scroll down to the bottom of the segment section, you can see where we include services, so accessories and other iTunes software and service growth here. So we'll now be able to add a whole another level of granularity to this model, assuming that they're going to continue to report this on a quarterly basis. And based on the discussion that Tim Cook had with some of the analysts, it sounds like they are planning on continuing to report this. So now let's get into the guidance. And rather than showing the split screen with the guidance from the SEC filing, we're going to bring up the model that we had last night prior to today's release on the left-hand side of the screen. And on the right-hand side of the screen is the updated model that includes the December quarter and the new guidance. So you can see all of these purple cells represent the midpoint of management's guidance, and we included the range in the comments embedded in the cells. So if we start with revenue, you can see that the street was expecting about 56 billion, and the midpoint of management's guided range came in at just 51.5 billion. Now the gross margin was much tighter than the past. So usually they give about 100 basis points of spread between the low and the high point of their gross margin target. So here they went with 39 to 39.5 percentage points, and they had 39 and 40% in the December quarter. So overall gross margin was actually very strong for the December quarter, and this guidance is actually pretty strong too. We were thinking that the additional costs associated with the iPhone 6s, including the additional 1 gigabyte of DRAM compared to the 6 version, and the haptic motor and the 3D touch functionality would actually have put some pressure on total corporate gross margin. So there was actually a good showing. And an additional point there is that the currency headwind should have impacted it as well. But the iPhone had such a strong ASP this quarter. If you scroll down to the segment sections, you can see it's $691. So that was definitely what contributed to such a high gross margin this time around. So that was a bit of bright news in the otherwise gloomy outlook for next quarter. Then we get down to operating expense. So in our previous model, which had a higher revenue base, we were actually expecting lower operating expenses. So now we have higher operating expenses on a lower revenue base, which is definitely not a good sign. Next, we get to other income, which they guided to 325 million. We had a bit lower than that, actually significantly lower than that, but again, there could have been a little bit of adjustment between our OPEX and other income. So we could have brought the OPEX up and the other income up and got to the same net EPS estimate. Provisions for taxes are now expected to be 25.5%, and they had an expectation of 26.2% and actually realized an effective tax rate of 25.3% last quarter. So after incorporating all of that additional guidance that management gave us, we had to make some assumptions about the diluted share count. And for that, we went to our share repurchase assumptions. Just clear these out. And our typical change in basic and diluted shares. So we're not gonna change those. We have those consistent with what we had before. And that gets us to a net diluted EPS estimate based on management's midpoint guidance and our assumptions for the change in share count of $1.97 a share. So well below the expectation of $2.24 prior to this call. So now let's take a look at the impact on share valuation. Let's scroll down to the valuation section below the cash flow statement. And we'll also scroll down to the same section in our model from last night. So you can see that as of last night, based on a 9 times next 12-month consensus EPS on an ex-cash basis, we had a share valuation of $110. So now with the new guidance, that earnings estimate is a little bit lower. The net cash per share is actually a bit higher, and that includes an increase in the balance of cash that is held in overseas accounts, which we take a haircut on to reflect the U.S. Repatriation tax if they brought the funds back to the United States and paid them out as dividends. So after accounting for those items and the lower earnings for the next 12 months based on that new guidance, the market multiple-based valuation in our model comes down to $101 from $110. Now on a DCF basis, we went from $132 to $126. So overall, we went from, when we use our 50-50 weighting of the two approaches, we went from $121 a share to $113.50 per share, which represents a decrease of about 6% per share. So shares are down about 2.5% after hours. Does the move make sense? Yes, our model is predicting a slightly higher percentage decline, but it's still well above the current share price. And we'll have to see what analysts do tomorrow after they finish updating their models, at which point we'll recalibrate our model to meet those new consensus estimates. So be sure to check back, and you can download the new updated model at that point.